Welcome to Thoughts on the Market. I'm Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about trends across the global investment landscape and how we put those ideas together. It's Friday, April 17th at 2 p.m. in London. The biggest question for markets remains, how do you safely reopen the economy? And for our thoughts on this, please see the recent two-part conversation between myself and my colleague Matthew Harrison, our biotechnology analyst at Morgan Stanley. But away from the virus, the most volatility is being seen in commodities, specifically oil. We think dynamics in the oil market argue for low prices today, but a return to higher prices, even a doubling of prices by next year. Let's start with what happened. Since the start of the year, the price of a barrel of oil in the US has fallen about 70% to less than $20 a barrel. And prices have continued to fall this week, even as equity and credit markets have now managed a healthy rebound from their lows in late March. This steep, continuing decline in oil prices is really a fascinating story of demand, supply, and even a little bit of game theory. The story starts with demand. Oil consumption has fallen sharply as the coronavirus pandemic has caused people to drive less, fly less, and generally do less of everything that consumes oil. Our energy analysts at Morgan Stanley estimate that the current recession could cause oil consumption to fall by about 15 to 20 million barrels a day, or about 15 to 20% of demand, a drop several times larger than what we saw during the financial crisis. In response to lower prices and this drop in demand, oil producers are trying to cut their own supply. Some of this is voluntary in an attempt to balance the market. Some of this is involuntary, as when oil sells for just $20 a barrel, many types of oil production are no longer economically viable. But the problem is one of scale. A recent global agreement to cut oil production is targeting about 10 million barrels a day and would be the largest production cut ever agreed to by the global community. But it's still far smaller than that drop in demand. And finally, there's a fascinating little bit of game theory. The Organization of Petroleum Exporting Countries, or OPEC, has long tried to coordinate their own oil production in order to support the oil price. But there's a catch. If you try to maximize the price of oil by cutting your own production, well, then other producers, like those in the US, will simply raise their production and enjoy those higher prices. It's a classic free rider problem. As such, our commodity team thinks that OPEC may be going through a more strategic rethink of that strategy. And in the near term, it might be more willing to tolerate lower oil prices and use those prices to push out those other producers, emerging with a stronger share of the overall market. All that means that oil prices could remain very low in the second quarter. But it also means that prices could be higher next year and the years after, as the global economic recovery and the supply cuts of this year once again balance demand. While the price of a barrel of oil in the US is about $20 today, our analysts think it could average about $40 a barrel next year, or about twice the current price. Thanks for listening. For more video from Morgan Stanley, please subscribe here to our YouTube channel, or you can subscribe to Thoughts on the Market directly on Apple Podcasts or your favorite podcast platform.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.